Hey friends, tax season is coming. I've got you covered with a 12-episode Saturday series running January through April. Each week, I'll share tips to help small business owners avoid tax season stress, get clarity, and lighten the load by delegating what you don't need to carry. Tune in every Saturday and step into tax season with confidence.
That $2,500 you just charged in your business credit card for your supplies, you didn't spend $2,500. Not yet. You created a $2,500 liability, a debt you still owe. And if you're not tracking it properly, you might lose the tax deduction entirely when April arrives. Most business owners treat credit card purchases as expenses the moment they swipe it. They see it in QuickBooks as an expense and think, okay, that's a deductible, that transaction is done, but it's not done. You still owe that money, and worse, if you haven't categorized it correctly or can't prove it was a business-related purchase, you'll lose the deduction when tax season hits. This confusion, this fundamental misunderstanding of credit cards and tax implications is destroying cash flow and costing business owners thousands in lost deductions. Today, we're fixing it by teaching you the right way to track and manage business credit cards for both cash flow and tax optimization. I'm Patricia Oholeguy, and this is Tax Season Saturdays. So let's dive in. Let me explain what's actually happening when you make a credit card purchase. Both in your books and for your tax purposes. You charge $1,000 for materials, and that moment, two things happened. You have $1,000 more in assets and $1,000 more in liabilities. The expense hits your books, but you haven't actually paid it yet. For tax purposes, that expense is potentially deductible, but only if you can prove it was business related, and only if you haven't documented properly. Here's the tax disaster I see constantly. A marketing agency owner came to me after getting an IRS audit notice. She claimed $42,000 in business credit card expenses on her Schedule C. The IRS wanted documentation proving that those expenses were legitimate business costs, not personal purchases. She had $9,500 in unpaid credit card balances and couldn't remember what half of the charges were for. She makes business and personal purchases on the same card. She had no receipts, no notes in QuickBooks about the purchases what they were for. No mileage logs for the business travels she had charged. Results? The IRS disallowed $18,000 in deductions because she couldn't prove they were business expenses. She paid tax on an extra $18,000 of income she didn't actually keep as profit, plus penalties and interest, all because her credit card tracking was not organized. And this is why proper credit card management isn't just about cash flow, it's about protecting your tax deductions. Every purchase you cannot document properly is a deduction you lose if questioned. How do you track credit cards in a way that protects both cash flow and tax deductions? And the first thing is that this is a non-negotiable for tax purposes. The IRS wants clear separation, so separate business and personal completely. Use your business credit card exclusively for business expenses. Never ever use it for personal purchases, not even just this once, when you forget your personal card. Why? Because the IRS can disallow all your deductions if business and personal are hopelessly mixed. They'll argue you're not operating a legitimate business if you can't even separate expenses properly. One personal charge doesn't doom you, but a pattern creates a serious audit risk. The second thing is you need to track liability accounts in QuickBooks. When you set up your credit cards in QuickBooks, they should be liability accounts, not expense accounts. Every purchase reduces your available credit, increases the liability that gets categorized to the appropriate expense account. This creates proper documentation when the IRS asks Prove this was a business expense. You can run a report showing this charge on this date for this vendor, categorized as an office supplies tied to Project X. That's the documentation that survives audits. Thirdly, you need to categorize every transaction correctly for tax purposes. Not all business expenses are tax deductible. Meals are only 50% deductible. Entertainment is generally not deductible at all anymore. Some expenses are deductible as assets and depreciation over time, not fully expensed in 1 year. If you're just dumping everything into the generic business expense categories, you're either over deducting or under deducting. So you're either having a risk when you get audited or you're overpaying in taxes. Proper categorization ensures you claim everything you're entitled to and nothing more. In our Clarity Compass membership, we teach IRS compliant credit card categorization every Monday night. We show you exactly which categories to use for different purchases, how to handle partial deductible expenses, and how to document everything properly for tax purposes. So now let's talk about credit card interest and why it's even more expensive than you realize from a tax perspective. Interest has a cost. A photographer client was paying $6,200 annually in credit card interest on business purchases. She thought, well, at least the interest is deductible since it's a business debt. Wrong. Credit card interest deductibility is complicated. For sole proprietors and single member LLCs, business credit cards interest is deductible on Schedule C, but only if you can prove the card was used exclusively for your business. If you mixed it even occasional personal purchase on that card, the IRS can disallow the interest deduction. For S-corps and partnerships, the rules are different. You may not be able to deduct the interest at all depending on your situation. You need to track and categorize interest properly based on your business entire structure. The carrying balance tax problem. When you carry credit card balance and you create tax planning nightmares, you claim the expense deduction in 1 year when you charged it, but you're paying it off in a year 2 or year 3 or year 4. The payment isn't deductible again. You already claimed the expense. But if your bookkeeping is messy, you might be accidentally deducting the same expense twice, or forget that you already deducted it and panic that you're missing deductions. Proper tracking prevents this confusion. When you track credit cards as liability accounts, the expenses hit once when you charge it, and then the payment just reduces the liability. Clean, clear, tax compliant. The monthly reconciliation requirements. The IRS loves to see monthly reconciliations. It proves you're running a real business, not just throwing random expenses on a credit card and hoping for the best. During an audit, organized monthly reconciliations with proper documentation significantly improves your credibility. And if this sounds like more work than you want to handle it while running your business, don't worry about it. We have white glove services that do exactly that for you. We reconcile every credit card monthly, categorize expenses for you, and track everything as liability property, and maintain IRS-ready documents year-round. When tax season arrives, everything's already organized and defensible. Once you understand proper credit card tracking, you can use cards strategically for both cash flow and tax optimization. You need to purchase $5,000 in equipment in late December. Do you pay cash or charge it? For tax purposes, if you want to charge it on December 30th, that expense is a deductible on this year's tax returns, even though you won't pay the credit card bill until next February. If you pay cash in January instead, you'll wait a full year to get that deduction. This is called cash basis accounting. Expenses are deductible when incurred, not when paid. Credit cards let you time deductions strategically if you understand the rules. Every credit card charge needs a purpose note in QuickBooks, not just a category, but why Office Depot, printer paper for client proposals, or Shell Station, mileage to Henderson's job site, or Amazon project management software description. These notes take only 10 seconds per transaction, but save hours if audited. The IRS can't disallow a deduction you cannot explain clearly with documentation. They can easily disallow one you have. The IRS cannot disallow a deduction that you have explained clearly with documentation, but they can easily disallow one when you don't have any records of it. Every Monday night in the Clarity Compass membership sessions, we review last week's credit card transactions together. We make sure everything's categorized correctly, everything has proper notes, anything questionable has support documentation, and this week's habit prevents year-end scrambling when you can't remember what that $247 charge was for 6 months ago. When your credit card's tracking is accurate, you know your true expenses in real time. This means you can calculate accurate quarterly estimated taxes based on actual profit, not guesses. No more surprise tax bills because you thought you had $8,000 in expenses, but actually only $5,000 were properly documented and deductible. Your business credit cards are either tools to maximize tax deductions while managing cash flow strategically, or they are chaos creating lost deductions and audit risks. The difference is entirely about how you track and manage them. Right now, you probably have credit card expenses, you're claiming them, and probably are not being documented properly. You probably have deductions you're missing because categorization might be wrong. You probably have interest charges you think are deductible, but may not be. And you probably are creating unnecessary audits through messy, inconsistent tracking. Every Monday night at 7 p.m., our Clarity Compass Method membership tackles credit card reconciliations with tax optimization in mind. We make sure every transaction is tracked correctly, categorized properly for tax purposes, and documented in ways the IRS accepts it. We catch errors before they become audit problems. Can't make it to the Monday nights? Don't want to handle it yourself? Our white glove services manage everything for you: credit card transactions, tax compliance, categorization, monthly reconciliation, and all the paperwork ready for you. That way you can get the maximum deductions and zero audit risks. Your credit cards should be working for you, and your tax optimization strategy should also be working for you. So let's make that happen. And thanks again. Thanks for tuning into the Tax Season Saturday series, and I'll see you on the next episode. Bye.
Hey, thanks for joining this Saturday's tax season special. Don't forget, you can join the Clarity Compass membership for weekly support or reach out for our white glove bookkeeping services. And remember, we're not lawyers or accountants, just your guide to clarity. Catch the next Saturday episode in this special tax season series. See you then.